Since we learned about types of charts and got familiar with time frames, it is time to cover basic candlestick patterns. These basic patterns also could be used with a bar chart, if you choose to trade with it. It is just harder to notice them there. Before started, important to say that these patterns is not a trading signals, not for professional traders. It might be used as an extra sign to confirm your trading signal or market direction, but never as a primary signal. Never. I hope I made that clear. Anyway, it is still important to know these patterns for common understanding. Bullish candlestick patterns. Bullish candlestick patterns may form after market downtrend or as a signal of reversal in price movements. Hammer. The hammer candlestick pattern is found of a short body with a long lower wick and is found at the bottom of a downward trend. A hammer shows that although there was a selling pressure during the day, ultimately a strong buying pressure turned the price back up. Let's get to the chart. As you can see down here, there is a candle with a small body and long lower wick, which afterwards leads to the price pullback. Inverse hammer. A similar bullish pattern is inverted hammer. The only difference being that the upper wick is long while the lower wick is short. It indicates a buying pressure, followed by a selling pressure that was not strong enough to drive market's price down. The inverse hammer predicts that the buyers will soon have control of the market. Let's get to the chart. As you can see down here, this red candle has longer upper wick while the lower wick is short, which afterwards leads to the price pullback. Bullish engulfing. The bullish engulfing pattern is formed of two candlesticks. The first candle is a short red body that is completely engulfed by a longer green candle. Though the second candle opens lower than the first, the bullish market pushed the price up, ending in the obvious win for buyers. Here it is two candles, second one red, fully engulfing the first one, which is bullish sign, and as you can see, market kept going upwards after that. Piercing line. The piercing line is also a two-stick pattern, made up of a long bear candle followed by a long bull candle. There is usually the obvious gap down between the first candlestick closing price and the second candlestick opening. It indicates a strong buying pressure, as the price is pushed up to or above the mid price of the previous candle. Price must push up to or above the first candle middle. If it does not reach that level, pattern is not there. At this example, there is a small gap between those two candles. Second candle closes above the first one's middle, which indicates potential direction upwards. Morningstar. The Morningstar candlestick pattern is a three-stick pattern. One short-bodied candle between the long bear and the long bull candles. Traditionally, the star will have no overlap with the longer bodies, as the market gaps between the open and close. It signals that the selling pressure is subsiding and the bull market is upcoming. Let's get to the chart. As you can see down here, middle candle with a small body between two long-bodied candles, which afterwards leads to the price pullback. Three white shoulders. The three white shoulders pattern occurs over three candles. It consists of consecutive long bull candles with small wicks, or without wicks at all, which opens and close progressively higher than the previous candle. It is a very strong bullish sign that occurs after downtrend, and shows steady advantage of buying pressure. Here it is a live example. Three bull candles, one after another, indicating potential direction upwards, which was obviously the case. Bearish candlestick patterns. Bearish candlestick patterns usually form after an uptrend, and signal a point of resistance or as a signal of reversal in price movements. Hanging man. The hanging man is the bearish equivalent of a hammer. It has the shape but forms at the end of an uptrend. It indicates that there was a significant sell-off, but the buyers were able to push the price up back again. The large sell-off is often seen as an indication that the bulls are losing control of the market. Shooting star. The shooting star is the same shape as inverted hammer, but is formed as an uptrend. It has a small lower body and long upper wick. Usually the market will gap slightly higher on opening and rally high before closing at price just above or close to the price of previous candle. Bearish engulfing. A bearish engulfing pattern occurs at the end of an uptrend. The first candle has a small bull candle body that is engulfed by a subsequent long bearish candle. It signifies a peak or slowdown of price movement and is a sign of an upcoming market downturn. The lower a second candle goes, the more significant the trend is likely to be. Evening star. The evening star is a free candlestick pattern that is equivalent to the bullish morning star. It is formed of a short candle sandwiched between the long bull candle and the large bearish candles. It indicates the reversal of an uptrend, and is particularly strong when the third candlestick erases the gains of the first candle. Three black rows. The three black rows candlestick pattern comprises of three consecutive long bearish candles with short or non-existing wicks. Each candle opens at a similar price to previous candle closing price without gap, but selling pressure pushed the price lower and lower with each close. Dark cloud cover. The dark cloud cover candlestick pattern indicates a bearish reversal. It comprises two candlesticks. A bearish candlestick which opens above the previous bullish candle and closes below its midpoint. It signals that the bears haven't taken over a session, pushing the price sharply lower. Price must be pushed up to or below the first candle middle. If it does not reach that level, pattern is not there. The reason why I didn't show live examples of bearish patterns? Just because they reflect bullish patterns, just in another direction. And it will be a great opportunity to search for the patterns by yourself at the chart. Thanks so much for watching, and if you found this video helpful or interesting, please give it a thumbs up. It really helps the channel to grow. And if you like to see more content like this, make sure to subscribe and hit the notification bell so you don't miss any future videos. I would also love to hear your thoughts or questions in the comment below. Thanks again, and I'll see you in the next video.